So right now there is so much negativity around Disney stock, and we know the biggest driver of sentiment is the share price, and when the share prices are very low, sentiment surrounding the stock is always very low. So with that all around the stock, does it deserve to be down here? Is this a stock to be avoiding? Or is actually this creating a bit of a buying opportunity into Disney stock with one of the most, or a lot of the most iconic brands out there? Hopefully this update into Disney stock is useful. Let's get started. And just a little shout out, if you do want to support the channel that lets me able to make these 5 videos a week on YouTube, then join the Patreon. It's £5 a month, it supports the channel, as well as that you do get 2 exclusive videos a week on there. We did just do a review of Diageo, and I'll also post my live buy and sell alerts on there. I did just buy a new stock actually, and you also get to join a Discord with 500 members on to talk about stocks as well. And as well as that, if you do want some free shares, join Trading 2 in the link in the description. You can get a free share worth up to £100. But let's get stuck onto Disney. So you'll see here Disney in the last 5 years, it had a bit of a run up before the CV times. A lot of this was the excitement around the parks and then having these parks, but then adding in this streaming business as well, where they're able to have their own content on the streaming platform and creating this new additional revenue or income stream. Now, obviously the CV dip happened. Obviously people worried about all the parks shutting down. But after that, we saw the explosion because they timed the launch of Disney Plus absolutely perfect. The share price went a little bit crazy, as you can see here. Also, people started factoring the parks opening back up. But since that time frame, since the peak of CV, everyone staying at home, everyone getting the streaming platforms, Disney has struggled on the share price. And there's a lot of reasons why this stock is now down 50%. There's a lot of reasons why the share price is now actually below the CV times. There's a lot of reasons actually why it's now lower than where it was 5 years ago before it even announced Disney Plus. So I can't cover all the big reasons today, but I'm going to try to do the main ones that I think are causing a lot of negative sentiment in the share price, and later on in the video we'll talk about if this is an opportunity to buy. So first of all, I think some people forget about the moat that's here. This is one of the most iconic brands out here. You talk about owning ESPN, you talk about owning Marvel, Lion King, the Disney Cruise Line, Lucasfilms. There's so many brands that Disney have, and the thing is when you do have these brands like this, you can utilize them amazingly. And I think that's the big question that Disney have had recently, is have they been utilizing them brands to the best they can? And that is maybe why the share price has been a little bit disappointing in the last kind of 5 years. Now, one thing before we get onto negatives is that I think people need to put into context is that obviously Disney Plus was announced on November the 12th, 2019. Since that time frame, people forget how much of a boom the financials of Disney have had. You can see here, previously to just having the parks, you can see the company was growing revenue quite steadily and the profit as well, steady as well. And they used to have very good profit margins. Now, when you see the explosion of Disney Plus, and also you got to take into context the parks actually shut during this time frame, you can see here the revenue just before the CV times was now 59 billion. The revenue now stands at 87 billion. That's how much Disney Plus has helped the business. Now, the big difference is that you can see here the profitability is around about 10 billion before the CV times with an 18% profit margin. That has now decreased to 2.6% and 2 billion in profit. And there lies the first issue, is that I think people forget the booming revenue that Disney Plus has created, but also that has also seemed to drag down the profitability, where the company was a big major company with the profitability previously. But getting back to the content point of view, there has been a big backlash on some of their recent films. There's been a little bit of a backlash to the recent film The Little Mermaid. We've seen that continued into Snow White, and that's caused some issues around are people going to go see these films. Now, what I was going to say here is that even during this time frame when Disney's supposed to be going through a tough time, when you do look at the 2023 worldwide box office, you'll see here that they actually do have Guardians of the Galaxy in 4th place. You'll see here The Little Mermaid, that was supposed to be this controversial film, still came in 7th. And you'll see here they also have 9th with Elemental, which is a new brand that they're trying to build up at the moment. And Ant-Man and the Wasp is also in 10th place. So even though this has been a so-called disappointing year for Disney and the content they're putting out, you can see here that even though it's been a disappointing year, they've still been able to put 4 of the top 10 worldwide box office films out there which is pretty impressive. Now, there is the little issue that Disney is going to start cutting back on some of its spending on some of its products and the content that it is putting in there. So that is something to be careful of, but if they can cut it back in the right place, then hopefully this can also drive up the profitability. And you've got to remember, Netflix went through a same sort of situation. Netflix went through a situation where they were at a point where they were criticised for having lack of content through 2022, and that causing poor subscriber growth. Now, I do believe some of this was because of the CV situation, the boom that we had because of the streaming, but there was a lack of content coming out for Netflix, and also as a lot of other platforms like Disney, for example, were building up their own streaming platform, they were pulling content off Netflix. Now, what Netflix actually did is they had then a really good rebound in the content. They were able to bring out Jeffrey Dahmer series that went absolutely ballistic. They were able to bring out other series like You, Wednesday, obviously the big brand that they have created, which is Stranger Things. Netflix was able to get to a point where they were going through something similar. They had to do a lot of cost cutting, price increases, and you can see here the share price has now recovered and they're currently trading at 47 times earnings and doing very well. So you can see here there is times where even another company that was similar in the space has been able to rebound from these sort of situations. Now, when we do start digging into the financials of the recent quarter of Disney, the recent quarter showed 4%. Now, this was a weaker quarter and it is expected to go back up to higher growth in the next quarter, but 4% is still not too bad growth. Obviously, I think the big thing is that a few investors would like to see that a lot higher, and that's why personally for me I got in this higher, is that where we were previously with Disney, I was expecting, okay, we've got this steady revenue and profit growth, parks that are going to do very well for us, and then we add into a Netflix style streaming platform that will also increase the revenue growth, so we'll have a profitable company with also good revenue growth. So for me, I do want to see revenue growth go a little higher. The big thing though that most investors are not happy about is that the profitability has not been ramped up. Now, if you look here in the recent quarter, you can see here income from operations was negative, and this was a big swing here, which is causing the issue around Disney. Now, there is a lot of changes that are going on in Disney, so you can see here there was a big restructuring charge that did happen in that quarter, and the big issue at the moment is the Disney media part of the company isn't performing as well as what it should be doing, but the parks are still doing very good. Now, when we do look at the operating income, as you can see here, if we dig into what's going on in that media business, you can see here the linear networks is decreasing. Now, this is to be expected as a lot of consumers are switching towards the streaming side of it. So unfortunately, I don't expect too much improvement in this sort of area. Now, the big thing is the direct to consumer, which is the Disney Plus side of it. The Disney Plus side of it as well does also create a big amount of losses. Now, the losses are starting to come down. This is to do with the price increases and starting to pull back the content they are putting on there. Now, a few people do say that the direct to consumer is also showing negative growth in subscribers. But the big thing is that they have just increased the prices. So when you increase the prices, there is going to be a bit of a churn of people going, I'm not paying that, I'm leaving. So I think the subscriber growth will return, and it is forecast for streaming to still do very well going forward. So I think that the issue is that the growth will still be good, and these price hikes will start kicking in, and we should see this direct to consumer start moving a bit more to profitability, which is the aim to get there into 2024. You'll also see content sales and licensing was also down as well. So there's a lot of headwinds going on, and it's nothing to do with the park side of the business, as we can see here. A lot of it is to do with Disney media and entertainment distribution. And like I said, I think a lot of it gets put on controversial film releases. But as you can see, I think the film releases are still doing okay. Granted that there isn't the big hitters nowadays of the Marvel films and the Avenger films and the Star Wars films. I think they can still generate the content to still do well from that. I think there's just a combination here where they're just trying to find the feet, where a lot of these restructuring and impairment charges are in here. The Disney media side of the business is obviously a little bit weaker because of the linear networks, and there's still the pause of driving up that direct to consumer. but I think they can get there. And with Bob Iger returning to the business, his main priority is to start driving up that profitability, and we have started to see that happen. We've started to see them start laying off the jobs. We have seen them trying to implement a 5.5 billion in cost cutting, and their also aim is to bring back the dividend, which I don't agree with, but it is worth factoring in that you are going to be picking some form of the dividend up by the looks of it, which is the plan. Now, if we look at what analysts are projecting, they are expecting the profitability or the EPS to start ramping up. They are expecting 6% revenue growth this year, with a forecast at the moment of 5.3% revenue growth next year. So let's look at what's going on and let's get a valuation of, is this now a decent valuation? So let's take a look at some of the Disney's numbers now and let's see if this is a good valuation. So Disney, 150 billion market cap. I've got the company currently trading at $82.52. So if we look here, I've gone on the low side, I've gone 3% revenue growth, and on the mid side, 5% revenue growth, on the high side, 7% revenue growth. For me, I would expect them to come somewhere between the 5% to 7% revenue growth. 3% is just a bit of margin of safety that if they do disappoint, then I can still make a little bit of money on this one. Profit margin, this is the key thing. The profit margin is going to be the make or break of this investment. Now on the low side, I've put 8%, midpoint 10%, and on the high side 12% profit margin. Now when we do look at Disney, their past profit margin has been very high. You can see here that they have been 14%, 15, 16, 20%, but obviously the media side of the business has been starting to drag that down a little bit. So how close can they get back to them old profit margins? Now the other thing worth pointing out is when you look at Netflix. Netflix's profit margins have been rapidly improving. It shows you that Disney can get their media platform up to higher profit margins, and even if they were only able to get part way to what Netflix did, so if you look at Netflix, they actually got up to a 4, 7, 10%, 15%, 14%, currently 13% profit margin. So even if Disney were able to, on the Disney Plus side and on the media side, only even able to get to like a 7% profit margin, the thing is, because Disney has the parks that are very profitable, they could actually drag up and make up the difference what the media side of the business is letting them down for. So Disney really should be able to get to the levels of Netflix and not just match it, but probably actually be able to beat it, because they have the profitable part business to drag it up. So kind of gives you an indication of where they should be on a profit margin. It is also worth pointing out that analysts are forecasting that they will get to a 10% profit margin in 2025, which isn't that far away. So when we do go back to our numbers that we were using, you can see here 8 would actually be very disappointing if they were only able to get up to an 8% profit margin. 10% would be okay, but we expect that to be there in 2025, never mind when we get towards 2026, 2027. 12% would be a little bit better, but even that I think is still conservative, but we would expect them to be at least getting somewhere towards there. Now I have put this all as a multiple of 20 times earnings, and you can see here on the low side there is a little bit of upside, but not much. Obviously there's a dividend to add in, but obviously we probably underperform the S&P 500 here, so that would be disappointing. But at the same time, we would be disappointed if they did 3% revenue growth and 8% profit margins. That would be below our expectations, but at least it's not lower than where it is right now on a share price point of view. Now when we get back to the numbers that we're expecting, we start to see 5% revenue growth, 7% revenue growth, and then the profit margins are a lot higher at 10, 12%. And that's where we start to see a lot better upside on the share price. Now, you might be saying, well, it's still not 100% upside. For me, you guys know me, I like to buy a stock and like to make 100% return on it. And you might be saying, well, it's still not 100% return. But the thing is that these numbers are still quite conservative. Like I showed you there, you could still see the profit margins get dragged up even higher than this. You might see the profit margins actually get dragged up to say 14%. Let's say then you've got your 100% upside. Now the big thing is that Disney's really beaten down right now. The sentiment's really low. If the market all of a sudden sees Disney start pulling out these sort of numbers where they're doing 7% revenue growth and the profit margin starts going up to 10% or up to 14%, is the market going to trade it at 20 times earnings, or is the market going to go, you know what, this is a premium brand and you're getting a dividend as well, let's put it a bit more of a premium valuation? And the thing is, when you look at like Nike, once again, premium brand, trades at 20 times earnings. I think Starbucks is like 28 times earnings. I think McDonald's is like 25 times earnings. I think Netflix is 46 times earnings. So when you start looking at all premium brands, they don't trade at market average valuations, they trade at a bit of a premium. So you start saying, well, what happens if the market then goes, actually, let's put Disney at 25 times earnings. Your upside is even more bigger then. Let's say the market goes, let's put it at 30 times earnings, even plenty of upside there. So your combination of if Disney's going to be successful in the next few years comes down to what's your revenue growth going to be? Are they going to achieve that 5 to 7% range, and can they get that profit margin at least to 10%, but then start dragging it into the teen range? That will be where that's where you'd see a lot of very good upside, and the market probably will put it at a bit of a premium then as well. Now, without doubt, if you are able to get the stock more towards $70 or even, let's say, $60, that is definitely going to increase your upside. So I would say that if you do see it even drop more than that, that's where you're going to see even more of an upside, as you can see here. If we do see a 10% drop on the company, your upside is definitely increased there. So if you can even get it cheaper into the $70, $60 range, that would be absolutely amazing. But that's something to just keep an eye on as well. So when I look at Disney at the moment, I would say that if you can get it into the $70 and $60 range, that would be absolutely amazing. But right now, I would say the risk to reward is there, because when you look at the low side, it does suggest that you'd be okay if they do underachieve at the moment. But if they were able to get back to the profit margins that they used to do, or a Netflix style profit margin, and obviously they should be helped to achieve that with the parks, the profitability of the parks, then you should do okay from this investment. So for me, I look at it going, do I want to sell? I think there's just that much negativity priced into the sentiment at the moment, in the share price, that I think that it's just gone a bit too low at the moment. And if I am looking to buy, I actually don't think it's that bad, because if you believe they can get to the all profit margins or Netflix style profit margins, you should do very well from this investment. So if anything, I'm probably looking at this more from a buying point of view at the moment. So overall, that's my opinion with Disney. I hope you enjoyed the video and there's some useful information there. If you could, hit the like button, and if you're new around here, subscribe, and I'll see you on the next video.